Hello and welcome to the Chapter 17 lecture. This set of videos, or these sets, this particular set of videos for this chapter, tiny bit different because on the exam you won't find any longhand problems for Chapter 17. Most of the calculations in this chapter include ratios. So I know you guys know how to divide. It's just a matter of looking at the ratio, pulling the right number, and then dividing the two. So that part of it is pretty straightforward. So there won't be any walkthrough videos, and the lecture video probably won't be that long. I anticipate doing one cohesive lecture video, but in this chapter, I'm super excited about this chapter because I get to tell you I get to show you another piece of the picture as it relates to accounting. Some people think that bookkeeping is accounting. If you know how to do basic journal entries, if you know how to work QuickBooks, then you can be an accountant. And that's really not it at all. What real accountants do is the analysis of financial statements. There's always a story behind the numbers, and looking at the numbers is not enough to tell you that whole story. You have to be able to look at look at those numbers, transform data, make comparisons, and then be able to draw conclusions about the financial health of a company. And we actually get to do that in chapter 17. So we get to go a step beyond just doing journal entries. Now, don't get me wrong, I love journal entries. They have their place, they're super important as well, but it's only one part of accounting. I need that building block of financial statements to be able to do this analysis piece. So now that we have gotten through all of our assets, all of our liabilities as far as accounting 1, and the first part of accounting 2 goes in terms of sole proprietorships, partnerships, and corporations, we've learned enough information to be able to analyze our financial statements and draw important conclusions. So why do we even do financial statement analysis? Well, as I mentioned, there's always a story behind the numbers. And those people inside of the company, as well as those people outside of the company, they're looking at the financial statements to make decisions about whether or not they're going to invest in the company, loan the company money, or what direction they're going to take from the future. So looking at the financial statements helps them to assess the financial condition of the company. They're going to look at past performance as well as what's going on right now, what their financial position is right now, as well as what could potentially happen in the future. So when we talk about internal and external users, I'm taking you back to chapter 1. Internal are those inside of the companies, like CEOs, key managers. External, investors, stockholders, banks, government agencies, but just those outside of the company. So when we do financial statement analysis, there's really 4 different building blocks that we use as a lens to help us examine the overall health of the company. The first one is liquidity and efficiency, and this deals with the ability for us to meet our short-term obligations. So when you see liquidity, I'm really talking about how liquid a company is, or how much cash, how much current assets they have on hand. So because we're looking at things in the short term, we're really going to be focused on the relationships between our current assets and our current liabilities. For the efficiency piece of it, we have to spend money to make money. And we're hoping that the use of those liquid assets, like our current assets, we're hoping that they help us generate revenue. So we sort of tie those 2 numbers together. So when we talk about efficiency, we're talking about how well we're using our current assets to help us generate revenues. Solvency is more of an eagle eye building block in that we're looking at long range. Can we meet our long-term obligations? When a company is insolvent, it cannot pay its debts. So we want to be able to make sure that the company can meet all of its long-term debt, whether it's bond, notes payable. Can they meet them? Profitability is all about net income. Yes, the company can pay its bills. Yes, they can meet their long-term debts, but are they profitable and will they continue to be profitable in the future? So we're looking specifically at the income statement and the generation of net income. And market prospects. How does the market perceive this company? Because yes, in order for a corporation to continue, they have to generate revenue, but they also have to raise capital or raise money by either issuing debt or issuing stock. You're not going to be able to issue so much in stock or debt either if the market doesn't perceive them in a positive light. So we also look at market prospects as well as one of our major building blocks. So what do we need to be able to do our financial statement analysis? We need our income statement. We need our full set of financial statements. So all of them: income statement, balance sheet, statement of stockholders' equity, cash flows, as well as the notes. Please remember that you do not have a complete set of financial statements without the notes to the financial statements. It does help to tell the story behind the numbers a little bit more, but again, we still need this financial analysis piece to tell the full story. Now, once you get all of that information, and you're looking at one company and you see, oh, this company made $1 million in profit. Is that good or bad? Well, you ask yourself a couple of questions. How much did they make last year? How much did they make in comparison to their competitor? What about the industry? Did the industry as a whole make 2 million and then this company only made 1 million? Well, what you're doing there is comparing. Yes, it's good to know the numbers, but you also need a standard of comparison so that you can appropriately interpret your results. So we can compare ourselves to ourselves by looking at what we did in the past. We can compare ourselves to our key competitors as well as the industry. And then there are general guidelines or rules of thumb. Like, I'm looking for my current ratio to be at least 1. And we'll talk about current ratio a little bit more. So there are 3 basic tools of analysis that we can use. We can look at our company across time. So that's horizontal analysis. We can compare our company to a base amount. So we could express everything on the income statement as a percentage of sales, or everything on the balance sheet, as a percentage of assets. That's known as vertical analysis, which gives us some pretty nice graphs that makes life a little bit easier in terms of interpreting results. And then there is ratio analysis, where we look at the relationships between certain accounts that we'll find on the balance sheet, the income statement, and that information will give us an easier way to compare what we've been doing in the past with what other companies are doing, and it can help us interpret our results a bit further. So let's look at horizontal analysis, where we're looking at information over time. And believe it or not, you have already done horizontal analysis when you did the statement of cash flows in chapter 16. One of the things that you needed in the statement of cash flows was a comparative balance sheet, where you got to see the amount that you had on your balance sheet from last year versus this year. And you use those dollar changes to help you compute the net cash provided by or used by operating activities. But the dollar change is calculated by taking the analysis period amount minus the base period amount. The analysis period is always the current period. That's the one that we're examining right now. The base period amount is typically last year when we're talking about comparative financial statements. Now we can take this dollar change and take it a step further and express this as a percentage to find a percentage change. When I was an auditor, that's one of the first things that we did when we got out to a client. We asked them for their trial balance. They gave us their trial balance, and we input those numbers into our Excel spreadsheet so that we could compare the difference between last year's numbers and this year's numbers. We calculated a dollar change. We calculated a percentage change. Any percentage change that was over 5% and any dollar change that was over $10,000, we investigated them. We asked questions. Hey, why did this increase by this amount? Why did this decrease? And it gave us an excellent jumping off point in assessing the financial health of that particular company. But to find the dollar change percentage, you're going to take the dollar change, which again is the current period minus last year, and then you're going to divide it by the base period amount or last year's amount. And then when you multiply that times 100, you're going to get an actual percentage and not just the decimal. So here is a comparative balance sheet. We have our current year, we have our prior year, then we have our dollar change, and we have our percentage change. We can also create a comparative income statement, which is really, really useful. If I look at the bottom here and I see the net income increase, then I would expect for sales to have increased. Some of my expenses may have increased as well, but overall, I would expect for my sales to increase, or at least for my sales to be increasing faster than my cost, because I still had an increase in net income. And we get to see that as a percentage. Oh, look at other income. That has a percentage change of 103%, went way up. I wonder what happened. Now, for trend analysis, this is another type of tool that we'll see in horizontal analysis. And this is where we're comparing current years, or maybe the past 5 years, to one base year amount. So we're calculating trend percentages, and it allows us to see how the company's costs may have increased over a 5-year period. So using a comparative balance sheet is really helpful when I just want to compare myself to what I did last year. But if I want to find a pattern or a trend in growth, then I need to use trend analysis. For this one, we take the analysis period, which is the current year, and we divide it by the base period amount. And the base period could be 5 years ago, depending on how long of a trend analysis we're looking at. And of course, we multiply it times 100 to convert it to a percentage. So for this one, it looks like we're looking at a 5-year period here. So we have 1 year ago, 2 years ago, so on and so forth, and this is the current year. And we're doing this for sales, cost of sales, and operating expenses. We're going to divide our current year by the base year amount. And the base year amount is the amount from the oldest time period. So notice down here, that percentage is 100%, because I'm dividing the net sales for 4 years ago by the net sales, again, for 4 years ago. And everything gets divided by the 4 years ago number. So my current period does change based on whether I'm looking at current year, 1 year ago, 2 years ago. Now, I'm not going to make you calculate trend percentages, but I do want you to be able to see the power of this tool. This allows me to see how my sales are changing in comparison to my cost, whether it's cost of goods sold or cost of sales, or my operating expenses. Now look at the green line. The green line represents operating expenses. This means that my operating expenses are increasing faster than my sales, which is a problem for me, because at some point that's going to start to eat into my profits. Notice that gap is getting wider and wider because my operating expenses are increasing faster than my sales. I got to get my expenses under control. A trend analysis helps to reveal this. Now let's go back for a second and let's take a look at these numbers. You look at these numbers and all this stuff starts to run together. Okay, a key executive is not going to take the time to look at all these numbers and calculate the differences. They'll glance at them quickly and they'll see that there's some changes, but what they really want to see is a graph like this on a dashboard that shows them at a glance, oh my goodness, my expenses are increasing faster than my sales. So I either better strategize and find a way to increase my sales, or I need to get my costs under control. So that pretty much takes care of horizontal analysis, where we're looking at things over time. We're using those comparative statements, or we're using the trend analysis. For vertical analysis, remember we're comparing everything to a base amount. And the base amount for a balance sheet is total assets. So everything gets expressed as a percentage of total assets. For the income statement, everything gets expressed as a percentage of sales or revenue. So we take the analysis amount, which is everything other than total assets for a balance sheet, and we divide it by the base amount, and then we multiply it times 100. So take a look at these common size statements here, and it gives me an idea of the components or the composition of my assets. So looking at my assets, it looks like the majority of my assets are in long-term marketable securities, which are just a type of investment. that I have where I'm investing in other types of companies, just from an asset perspective. Now, for the income statement, I really like the common size statement as far as the income statement goes, because it allows me to look at my sales as the full pie. And what portion of that pie am I spending on cost of goods sold, on my operating expenses? What portion do I get to keep as net income? This becomes more powerful when you put it in a graphic depiction. Now, I don't like this graph. It's just not my favorite type of graph. I like the pie chart because it really drives home that this whole pie chart is $1 in sales. So for every $1 that I have in sales, I get to keep 19.8 cents as net income. That really drives home how I'm spending my sales. Most of that cost goes into cost of goods sold, which kind of does make sense, but it depends on the industry. That's one of those things where I'm going to compare myself to what I was last year, compare myself to the industry, compare myself to my key competitors. And that pretty much takes care of vertical analysis. Remember, we're comparing everything to a base amount, expressing everything as a percentage of that base amount. Now, let's look at ratio analysis. This is the portion of the chapter that takes the longest because there's so many different ratios. And I'm sure you've seen in the book as you read the chapter, or you'll see on the last slide here, that there are a ton of ratios listed there. I do not want you to memorize those ratios. I am more than likely not going to ask you a ton of questions on the exam about specific ratios, a few here or there, but I really want you to understand what types of conclusions we can draw from looking at those ratios. Because in the real world, you can have a reference sheet. You're probably going to have an Excel spreadsheet that already has formulas in there that calculates the ratios for you. The question is, can you explain and interpret the results of those ratios? So let's look at ratio analysis. And we examine ratio analysis through the lens of our 4 separate building blocks. So we have specific ratios that deal with liquidity and efficiency, that deal with solvency, profitability, and market prospects. Let's deal with liquidity and efficiency first. Now, keep in mind, we're dealing with items in the short term. So a lot of our calculations are going to include current assets and current liabilities. So keep that in mind. Let's look at these one by one. The first one is working capital. Working capital gives me an idea of how liquid the corporation is. Can they pay their short-term debts? So we take our current assets and we subtract out our current liabilities, and that gives us the amount of money we have left to work with that we can possibly use to invest in a certain way, whether we're investing in ourselves or investing in another type of company by purchasing their stocks and bonds. But the key is that the larger this number, the more liquid a company is, or they're in a strong liquidity position. Now, if this number is negative, then you don't have enough current assets on hand to cover your current liabilities. How are you going to pay your debt? Are you going to go out and get more debt in order to be able to cover these current liabilities? But this initial ratio helps us determine the liquid position of the company. Now, we can take this a step further, and we can take working capital and convert it into a ratio where we're taking current assets and dividing it by current liabilities. This is the same current ratio that we saw in Chapter 4 in Accounting 1. Now, typically, we want this number to be at least 1. If it's at least 1, then I have enough current assets on hand to cover my current liabilities. If it's less than 1, I don't like that. I'm in trouble. If it's more than 1, it really depends on the industry. So you still want to use that general rule of thumb, but you want to compare yourself and to the industry. Now, although current ratio is helpful, it is not the end all be all, because current ratio includes all of my current assets. And there are some current assets that I'm never going to convert into cash to be able to use to help me pay down my debts. For example, prepaid expenses. We never convert prepaid expenses into cash. I mean, we could, but that means we're getting a refund on some type of insurance policy that we've had. Typically, we're using up that prepaid expense, and then it eventually becomes an expense as we reduce the asset. So we have an additional ratio that can make current ratio a little more meaningful, a little more powerful. And we do that by excluding those assets that are not easily converted into cash, like prepaid expenses and inventories. And I say inventories, yes, inventories do eventually get converted to cash. But if I make a credit sale, that inventory kind of becomes accounts receivable because I'm waiting to get my money from my customer. And then when my customer finally pays me 30 days later, then I get the cash. So it's not quickly converted into cash. So because of that, we created, or I'm saying we created, the accountants, people from a long, long time ago created the acid test ratio, also known as the quick ratio. This is where we only include our quick assets. And there are only 3 quick assets: cash, short-term investments, and current receivables. Don't include inventories, don't include prepaid expenses. Those are not quick assets. Just cash, short-term investments, and current receivables. And we divide those by our current liabilities. This number is usually going to be lower than our current ratio, especially for a company that sells finished products, because they typically have a lot of inventory sitting on hand, so that can inflate their current asset number. When you take that out, you really get to find out how much they have to really be able to meet those current liabilities or those short-term obligations. Now, let's take it a step further. Let's move beyond liquidity and look at efficiency, because we spend money to make money, and we want to see if the policies we have in place are really helping us to generate some revenue, and not just generate some revenue. When we have receivables, I need to convert those receivables to cash. That's because I need the cash now. So there's a ratio to measure how many times a company actually converts their receivables to cash during the year. And we do this by taking our net sales and dividing it by average accounts receivable net. Keep in mind that it is net of the allowance for doubtful accounts. You learned about that in Chapter 9 in Accounting 1. But average accounts receivable is beginning plus ending divided by 2. Now, when you get this number, you may get something like 12 times a year. So that means the company converts its receivables into cash once a month, or 12 times a year. Now, is that a good number? Well, it depends on what their credit policy is. If that credit policy is 15 days, we're expecting everyone to pay us in 15 days, and they're only paying us every 30 days or 12 times a year, then we have a problem. Maybe we need to stop extending credit to those people. Maybe our credit policies and our credit restrictions, they're too restrictive because people can't pay us on time, so maybe we need to expand that. But those are some of the things, some of the questions that you'll ask yourself once you're looking at the accounts receivable turnover. Let's move on to inventory turnover, because I have inventory for the purpose of selling it. How long does it take me to sell it? How many times do I sell my inventory during the year? So for inventory turnover, we take cost of goods sold and we divide it by average inventory. And again, I may get a number like 12. Again, that means 12 times a year. If this is a clothing store, that's great. In 30 days, I should be getting new inventory anyway. But if this is the produce section of a grocery store, then we're not doing so well because we're selling rotten vegetables and fruit if they've been sitting there, or if it takes us 1 month to get rid of our inventory. Now, we can convert that accounts receivable turnover and that inventory turnover into days to make it more meaningful. And we do this by taking accounts receivable net and dividing it by net sales and then multiplying it by 365. But again, it sort of does the same thing as the turnover ratio, only instead of seeing the number of times a year, I get to see the number of days. So now I might get an answer like 30, meaning 30 days. It takes me 30 days to collect my receivables. Or for inventory, again, I'll see a number like 30 days. Now, total asset turnover really drives home the efficiency. So we're definitely moving, took one tiny step away from liquidity just a bit, even though those two ratios, four ratios I showed you kind of dealt with liquidity. They also deal with our efficiency in terms of converting that inventory to sales and converting those receivables to cash. But now we're really driving it home because we spend money to make money. And the money that I invest in myself in terms of total assets, that should help me generate some sales. So with total asset turnover, I take net sales and I divide it by average total assets. Again, beginning plus ending divided by 2. What's a good number in terms of this ratio? It depends on the industry. So you really have to look at the industry. It depends on what you did last year. It depends on what your competitor is doing. But generally, this is a rule of thumb, depending on the industry, maybe 2 times. You want your sales to be 2 times your assets, or your sales to be 3 times your assets. So let's move on to solvency. That really takes care of liquidity and efficiency. Solvency is all about meeting your debt in the long term. So we're going to see a lot of ratios that include those debt items. So with the debt and equity ratio, we're taking total liabilities and dividing it by liabilities plus equity. Or equity, we're taking the equity amount and we're dividing it by total liabilities and equity, so that we can see how we finance our company. Do we use more debt or do we use more equity? Now, looking at this company with this 64% in terms of the debt ratio, what this really means is they have more debt than equity. They're probably going to have a difficult time securing additional debt. We have a ton of debt outstanding. Now we can take this a step further and compare total liabilities to total equity, so that again we can see what portion of a company's assets come from creditors, what portion of the company's assets come from equity or investors. Now, times interest earned is, to me, a very strange ratio, but it is helpful. And what it tells me is how many times we could use our net income to pay our interest. Interest is not going away unless we pay off the debt. So we have to be able to cover our interest payments. Creditors like this because it gives them an indication of how much net income a company has in order to be able to meet its interest obligations. So you'll do this calculation and you'll get something like 11 or something like 9. And it means that a company using their net income, they can pay the interest 9 times. That total interest expense, they can pay it 9 times. Now, would they in reality do that? Absolutely not. But the higher that number, it's an indication that the company does have an ability, a better ability to pay their interest. So in calculating this, we do use income before interest and taxes, sometimes in finance circles referred to as EBIT, EBIT. That's earnings before interest and taxes. And then we divide that by interest expense. Now, that pretty much takes care of solvency. The longest one was liquidity and efficiency. Let's move on to profitability. With profitability, because I'm talking about profits, net income. So these ratios are going to be linked to net income. So for profit margin, we take net income and we divide it by net sales. So that percentage is going to give me an idea of how much net income I get to keep from each $1 that I have in sales. So for return on total assets, this is where instead of, remember asset turnover, I was linking my assets to my sales. Now I'm linking my assets to my net income. So it gives me a better measure, because yeah, I can have all the sales in the world, but if there's no net income, then I'm not being very efficient from the efficiency side of things. But it takes it even further because I'm not being profitable either, because my net income is too low. So this is another ratio that we can use to measure the profitability of a company. What's a good rule of thumb? Depends on the industry, depends on the company itself. And there's also return on common stockholders' equity. We want to keep our investors happy. You know, we ultimately, most companies will pay a dividend, not all of them. Some companies don't pay dividends, and I'll talk about that when we get to market prospects. But we want to keep our investors happy because they'll be willing to give us more capital in the future. The primary purpose of a business is to maximize shareholder wealth. So those are our owners. We want to keep them happy. So there is a measure that we can do to determine the profitability of each stockholder by looking at the return on common stockholders' equity. We take net income and we subtract out preferred dividends if there is preferred stock. Now we have to subtract out the preferred dividends because we want to look at net income that's allocated or preserved for common stockholders only. And if you have preferred stock, we know that they should get their dividends, so we need to subtract them out. And then we divide by average common stockholders' equity. Again, when you see average, we're saying beginning plus ending divided by 2. Now let's look at my favorite ratios, which are the market prospects. How does the market perceive us? Depending on how the market perceives us, that's going to be an indicator of whether or not we can raise additional capital. So we have 2 ratios here, even though there are a ton more ratios other than this, but we have the price earnings ratio and the dividend yield ratio. The price earnings ratio tells me whether or not a stock is a growth stock or whether it is an income stock. So what in the world does that mean? When a company has a growth stock, they take the earnings and reinvest the earnings in themselves. And when a company has a potential for growth, a lot of times they don't pay out dividends because they want to keep investing in themselves. But an income stock will typically pay dividends. And I'm getting ahead of myself because the dividend yield really helps me to determine whether or not a company pays out a dividend, because we look at the cash dividends and we divide it by the market price per share. So it does tie the market price to the actual dividends that are being paid out. Now, when you're looking at the price earnings ratio, when you calculate this ratio, if it falls within a certain range, then that's an indication that it is an income type of stock. When it falls within another range, and your book has those numbers for you, and I don't want to start yelling out numbers because I may give you the wrong numbers. I think it's 0 to 9 and then 9 to 24, something of that nature. But it does, where those numbers fall will give you an indication of whether it's an income stock or a growth stock. And from an investor's perspective, that's important for them to know, because people who are close to retirement want income stocks. They want to get paid those dividends. Those are the ones that are relatively safe. Companies have been established for a long time. But those who are willing to take on more risk may be a little bit younger, may not be as concerned about getting dividends, but they want that stock price to grow and grow and grow and grow. So because of that, they are willing to invest in a company that doesn't pay dividends. Now, when you see a company with an extremely high stock price, it's because they don't pay dividends. It makes the market price of that stock continue to rise and rise and rise and rise. And when you have that huge gap between the market price of the stock and the earnings price, the earnings per share, again, it's more of an indication that you're dealing with an income type of stock. Now, the price earnings ratio can sometimes also help us to see if a company is overvalued. And we saw that a couple of weeks ago in terms of when I'm recording this, maybe a couple of weeks ago in terms of when you're watching it. But we saw that with the Reddit feeds and what was going on with GameStop. I believe GameStop's earnings per share was negative. And their market price went through the roof. And when you tie that market price to the earnings per share, it's like an indication that this stock is overpriced, way overpriced, which from an investor standpoint can be bad, because you want to go in low and you want to sell when the price is high. But if you go in when that price is high and it's overpriced, then you could really be hurt when the market corrects itself. Because believe you me, the market will always correct itself. So price to earnings ratio does give us an indication about the market's expectation of the stock, as well as dividend yield. So look at this slide, summary of the ratio. There's no summary of all of our ratios. There's no way in the world I would ever ask you to memorize all of these ratios. It's just absolutely ridiculous. But I do want you to understand the difference between a liquidity ratio and a solvency ratio, and so on and so forth. Now, the last piece of this chapter really looks at an annual report, which will help you for your homework assignment for this particular chapter, because for your homework assignment, I am going to provide you with a link to a 10K report, which is the annual report of a specific company. And you're going to have to look through that report and calculate certain ratios. And that report is hundreds of pages long because it includes all of these items listed here. An executive summary, evidential matter, those are the financial statements. So that's what you're going to be looking for in terms of how to compute these numbers. You're going to see some assumptions, some key factors, and some conclusions that the company itself that they've drawn about their business. Now, the appendix to this chapter is probably one of the only appendices that I cover, and it's really short, but I only want to cover this because when you prepare an income statement has different sections because the users of the financial statements are going to draw conclusions looking at the income statement. When they look at the continuing operations, if there's net income of $1 million, there's going to be the expectation that all of the revenues and all the expenses will happen again because these are continuing operations. But what happens when a corporation decides to discontinue a particular portion of their business? Let's pretend that Nike decided to get rid of the women's shoe division. If I keep the net income from the women's shoe division in current operations, then someone looking at the financial statements will expect for net income to be the same next year. But in reality, it's going to be lower if I'm getting rid of a profitable segment. So there is a separate place where we report discontinued segments. And they're typically going to be two items that you're going to see there per event or per discontinued segment. There's going to be the income from that segment for the current year. And then there's going to be the gain or loss on the sale of that segment. So all of that has to be reported on the income statement, but it has to be shown separately from continuing operations. If there are any changes in accounting principles and how that impacts net income, that's going to be something that generally we're going to be able to see on this statement of retained earnings. But we separate that stuff out because we don't want to confuse our users of the financial statements and thinking that, oh, there was this big charge off for switching from LIFO to FIFO. Well, that's not going to happen every year. We're not going to switch from LIFO to FIFO every single year. And then earnings per share. Earnings per share was used in the calculation of the price earnings ratio, but this is a widely cited statistic. It is the only ratio that you're going to see on the face of a financial statement. And it tells you the earnings power of one share of stock. We're essentially taking net income and we're dividing it by the shares outstanding of common stock for that corporation. So when you see earnings per share, I want you to really think of net income per stockholder. And as I mentioned, GameStop had a negative earnings per share. So the income statement is all inclusive. Notice that we are reporting that discontinued segment. We're showing our earnings per share in terms of income from our continuing operations, which is up here, which is what you're used to seeing in Accounting 1. If you happen to prepare a multi-step income statement, you did that already, so all this looks familiar to you. And we also get to see earnings per share in terms of a discontinued segment as well. All right, that is the end of this chapter. I so appreciate your time and attention, and I hope you have a wonderful day.